BHP just settled a months-long dispute with China's state iron ore buyer, and the market barely flinched. Iron ore futures moved less than 0.5% on the news. That reaction tells you something, but probably not what most people think it tells you. The instinct is to read the settlement as a commercial resolution. BHP gets its biggest customer back, Jimblebar volumes return to normal, and the earnings base is de-risked. Josh Gilbert at eToro called it exactly that, a win that quietly removes risk from the iron ore earnings base. And on the surface, that framing holds. BHP's Western Australia iron ore operations produced 69.8 million metric tons in the March quarter, above analyst estimates, even while Jimblebar output nearly halved during the dispute. Restoring that flow matters. But the settlement terms are where the story gets more complicated. The contract for Jimblebar fines will now be priced using a weighted average of 4 indices. One of them is China's own Corax 61% Portside index, carrying a 26% weight in the formula. There is also a 1.8% vessel rebate on term contracts and a freight-linked discount for large ships. BHP declined to comment on the specifics. CMRG said nothing at all. So the market saw a supply resolution. Analysts who looked harder saw something else entirely, a structural shift in who gets to set the reference price for one of the world's most important commodities.
The distinction between a seaborne price index and a portside price index is not technical trivia. It is the core of why the steel matters beyond BHP's quarterly numbers. Traditional iron ore pricing is anchored to seaborne benchmarks, prices set in the international market where cargoes are sold and traded between producers and buyers. A portside index, by contrast, tracks prices at Chinese ports. It reflects what ore is worth once it has already arrived in China, in a market that China itself controls. Su Yidan, a ferrous metals analyst at GF Futures, told the South China Morning Post that this agreement marks the first time China's own market trading data has been formally incorporated into an iron ore pricing formula. The word used was paradigm shift. That phrase gets overused, but the logic holds here. When a buyer's domestic reference price carries 26% weight in a contract with the world's largest iron ore miner, the buyer has gained a structural toehold in price formation, not just price negotiation. Iron ore pricing has been a persistent geopolitical frustration for Beijing. China consumes the majority of global seaborne iron ore supply, yet the benchmark prices have historically been set in markets and exchanges where Chinese influence is limited. CMRG, the state-backed buyer established specifically to centralize China's purchasing power, was created partly to address that imbalance. The BHP deal is the first concrete evidence that the mechanism is working. The 26% weight is not majority control, but it is a precedent, and precedents in commodity pricing tend to compound.
Alicia Garcia Guerrero, chief economist for Asia Pacific at Natixis, put the competitive dynamic plainly. Once one major miner accepts a Chinese domestic index for a flagship product, the commercial and political pressure on Rio Tinto, Vale, and Fortescue gets, in her words, a lot harder to ignore. That pressure operates on 2 levels. The commercial level is straightforward. If BHP's Jimblebar fines are priced partly against a Chinese portside benchmark, and Rio Tinto or Fortescue hold out for purely seaborne indexed contracts, CMRG has a structural cost argument to favor BHP volumes. The buyer effectively controls which seller faces the softer reference price. The political level is less obvious but more durable. CMRG was not created as a temporary procurement vehicle. It was designed to reshape how China engages with commodity suppliers across the board. The BHP deal gives that institution its first pricing precedent. Beijing will point to it in every subsequent negotiation. Fortescue is the most exposed of the Australian trio to this dynamic. Its iron ore is predominantly lower grade, which already trades at a discount to benchmark. Bell Potter downgraded Fortescue to a sell this week, citing rising costs expected in the second half of calendar 2026 as low-cost inventories are exhausted, and flagging uncertainty around the Iron Bridge portfolio review. A structural pricing shift that further compresses realized prices on top of those cost pressures is a compounding headwind, not an isolated one. Rio Tinto, which commands premium pricing for its high-grade Pilbara blend, has more negotiating insulation. But Garcia Guerrero's point stands regardless of grade. Once the mechanism exists in one contract, the ask to replicate it becomes the baseline, not the exception. The reversal card here is this. most coverage of the BHP deal treats it as a China victory and a minor concession. That framing misses a counterforce that could limit how far the Portside index mechanism spreads. BHP's willingness to accept the COREX 61% weighting came in the context of a specific dispute. Jimble bar volumes were already restricted, and the commercial cost of continued exclusion from CMRG was real. The 26% weighting, paired with a vessel rebate and freight discount, may represent BHP's price for re-entry, rather than a template it would voluntarily extend to other products or other buyers. The terms were not disclosed by either party. That ambiguity cuts both ways. Evidence leans toward gradual extension of the mechanism, but only if Chinese steel demand holds at levels that preserve CMRG's leverage. If Chinese property and infrastructure demand weakens materially in the second half of 2026, the dynamic reverses. Iron ore producers regain negotiating position, and the Portside index precedent becomes harder to replicate, simply because buyers need supply more urgently than they need pricing control. The upside path for BHP specifically runs through copper. Analysts at Morgan's rate the stock a hold, noting copper at US 5.47 per pound average realized price over 9 months is doing structural work that iron ore cannot. A new CEO takes over on July 1st. Brandon Craig inherits a business where iron ore is the cash engine, but copper is the growth thesis. If that transition accelerates, the pricing concession on Jimble bar fines becomes a smaller fraction of the earnings story over time. For Rio Tinto and Fortescue, the watchpoint is whether their next CMRG negotiation opens with the BHP framework as a starting position. If it does, the 26% Portside weighting was not a concession, it was the opening of a new pricing era for Australian iron ore. If Rio holds firm and CMRG accepts seaborne-only terms, the BHP deal remains an isolated data point. That outcome is possible, but the structural incentives do not favor it. The iron ore market is pricing near 2-year highs right now. That buffers near-term earnings across the sector. The pricing mechanism question is a slow-moving structural shift, not an immediate earnings event. But slow-moving structural shifts in commodity pricing are precisely the ones that compound over cycles without the market fully pricing them until they already have.